On October 29, 1929, panic swept through Wall Street. Known forever as Black Tuesday, it marked the most devastating stock market crash in U.S. history and the beginning of the Great Depression. On that single day, more than 16 million shares were traded as terrified investors tried to unload their holdings. Prices collapsed, fortunes vanished, and the economic optimism of the 1920s came to a sudden end. The warning signs had been building for months. The Roaring Twenties had seen explosive growth in industry, technology, and consumer spending. Millions of Americans invested in the stock market, often buying shares on margin, borrowing money to speculate. When prices began to slip in late October, confidence cracked. On Black Thursday, October 24th, 13 million shares were sold, sending shockwaves through the financial world. But the worst was yet to come. By the morning of October 29th, the market was in free fall. Major stocks plummeted, and the ticker tape could not keep up with the flood of transactions. Crowds gathered outside the New York Stock Exchange in disbelief as once-rich investors faced ruin. In just a few hours, billions of dollars in paper wealth evaporated, wiping out years of speculative gains. The crash did not cause the Great Depression on its own, but it exposed the deep weaknesses of the American economy: overproduction, uneven wealth, fragile banks, and heavy debt. Businesses failed, unemployment soared, and within a few years, nearly 1 in 4 Americans was out of work. The once confident nation faced breadlines, bankruptcies, and a shattered sense of prosperity. Black Tuesday became a defining moment in modern history. It reshaped the American financial system, led to sweeping reforms under FDR's New Deal, and forever changed how the public viewed Wall Street. The crash of 1929 stands as a stark reminder of how speculation can turn to panic, and how fragile economic confidence can be when built on risk and illusion.